Hello friends, CS Anuja this side. Lovely to have you all here with me today. Today we're going to be looking at your capital markets and securities laws. This is purely a recap session which I'm going to be doing for 40 marks worth of your CMSL subject. So when I say 40 marks, I'm basically talking about part A, which covers 7 chapters. Your chapters 1 to chapter number 7. I'll classify these 7 chapters into 3 parts. Basically, chapter number 1 and 2 covers your basics, like basics of primary market, who are capital market participants, your secondary market, etc. Then we have chapter number 3, 4, and 5, which can actually be studied together. There are a lot of interrelated concepts between the three of them. Okay, they're purely from a regulatory point of view. We have SCRA, we have SEBI, and then we have your Depositories and Depositories Act and depository participants. Securities market intermediaries is a standalone chapter, very important. We need to study it individually. There are more than 15 capital market intermediaries that we'll be looking at over here. And then finally, we have IFSEA. So we'll be doing a very quick recap over all of these. Friends, one small note that I want you all to keep in mind, this particular class or session is purely a recap session. So if you are preparing for your examination and you have not studied these concepts before, then don't rely only on this video to study your entire chapter because it will not be sufficient. You should have finished preparing for all your chapters, thoroughly studied it well, and then this recap session will be good for you. Okay, so keep that in mind. Don't assume that what you're studying here is only the end of it. You have to study more because CMSL is a technical subject. Fine. So let's start out. Now, we have to understand that I'm going to be doing this entire series purely from an examination point of view. And what I have done is I've actually created a question bank for CMSL where I have consolidated all the past questions for the last 2 years, at least from for the year 2025 and 2024, and I've classified it chapter wise. So you'll be able to see what questions were asked in December, in June, and subsequently like that. And I've also given some additional questions for practice with the answers. So if you want to access this, I will show you where you can access it. But we will also be referring to this past question paper. Okay, we'll be looking at the kind of questions being asked from here. And then we'll also be looking at a recap over all our chapters. Fine. So let's start out. I'm actually going to be starting out with chapter number 2 because I feel that chapter number 1 is extremely simple. You should have, we'll be covering all those concepts again and again through the remaining chapters. So we will come to that right towards the end. We'll start with chapter number 2, that is your secondary market in India. So even from your question bank perspective, let's just take it down. I'm going to take our chapter number 2 as the secondary market. We'll just take a look at how they've asked the question so far. Okay. Now in December 25, they asked only 5 marks from this chapter. In June 25, they've asked 5 marks. But in December 2024, they have asked like a paragraph, like a whole comprehension style question they've asked. And then they've asked the questions as individual questions, which would be like 2 marks, 1 mark, something like that. So why I'm starting out with showing you past questions is because you're preparing for your examination. You have to keep in mind the nature of questions that are being asked over here. Fine. And then they've actually, if you look at it in December 2024, they've asked a lot of questions from this particular chapter. So they've asked this, they've asked 5 marks, another 5 marks, and then subsequently another 5 marks. Close to 20 marks was asked just in December 2024 from chapter number 2. So in general, like if you had to ask me, ma'am, is this chapter important or not, it can be important. In the sense, don't just look at it like they're only going to ask 5 marks for this. No, study it in such a way where you can even be expecting 20 marks from this or even 5 marks from this. Now look at the 5 mark questions. Okay, very simple, extremely simple. Explain regulatory framework of secondary market in India. The next one, impact of RBI's monetary policies. Instant 5 markers you can get. You have to get a full 5 marks for both these answers. But then in December 24, they've given you a whole set of facts, and then there are technical questions being asked over here. So you should even know like pointers, immediate answers. You should write all these answers in one line and help to associate your answer with the correct provision. Fine. So let's keep this in mind before we start out with chapter number 2. Remember, friends, this is purely a recap session. So let's take a look at it. Your secondary market basically relates to your stock exchanges. That is the main thing. So when we talk about the stock exchanges, first let's try to understand what is their role. One, they help us to measure the economic activity of our country. They are a market wherein securities, what are securities? Your shares, scrips, bonds, debentures, your ADRs, GDRs, mutual funds, all of them, it's a market. Like how you would go to a marketplace to buy your vegetables, etc., etc. And to buy and sell securities, your stock exchange is the market. Evaluating securities, how do you know that something costs? If Reliance shares cost this much, or if your Tata Motors costs this much, the stock exchange helps us to evaluate shares. Then many people use this as a form of investment. Okay, but because more and more investors are actually involved in the stock exchanges have an important role of protecting investors. Then while they say it enables healthy speculation, truthfully there is also a lot of market manipulation that takes place. But SEBI is entrusted with ensuring that there is only healthy speculation. All right. And then finally, ensures liquidity immediately. If I have to sell my securities now, I can do it immediately and I can get the money within 2 days time, or even lesser than that. And then it's a great way to attract foreign capital. The one of the biggest factors of stock exchange is that it encourages transparency, and it actually forces company to do listings, compliances, disclosures, etc. And it is also to regulate company management. When the promoters are in the are in public scrutiny, then they can't do unfair dealings, they can't do fraudulent activities. So in a way, this is the role of the stock exchange. And in India, we have two stock exchanges, BSE and NSE. Fine. So when we take a look at stock exchanges, we always have to remember the one main law that governs stock exchange is your Securities Contract Regulation Act. Okay. So SCRA will be looking at in chapter number 3, but essentially SCRA governs the setting up of stock exchanges and also governing the stock exchanges. Um, Moving ahead, one this comes up in the latest amendments that has come up in your chapter number 3. So I'm just going to take out the supplements. Okay, these supplements are actually for December 2025. Friends, please understand, in December 2025 they gave amendments. In June 2026 there are no additional supplements given by ICSI. Okay, so we're just going to take a quick look at this chapter number 2. Okay, so chapter number 2, the one of the most important things that has been rolled out very recently is the concept of the T plus 0 rolling cycle. Earlier we used to have T plus 14, which is like 10-15 years ago. Then it eventually became T plus 2. T is nothing other than the trading day. Okay, the trading day plus 2 days is how long it will take for you to trade in the securities of any company. Now then they brought it to T plus 1. Then now they've rolled out a T plus 0 trading cycle. Now this T plus 0 trading cycle is not for everything. They have identified 25 companies or 25 securities in which it will be introduced, and if it is a good enough version, then it will be rolled out slowly to all the different companies. So right now they're saying it's only in the beta version of the T plus 0 trading cycle, effective from March 28, 2024. Applicable only to 25 scripts with a limited number of brokers only. So it's still in a rollout stage. Soon we will see that it's being rolled out to different places. Okay. Um, that's all with respect to the amendments of your chapter number 2. So let's come back over here. If you look at if you look at how your shares are actually traded on the stock exchange, the trading mechanism is in dematerialized form only, and not just dematerialized form. It takes place in something known as screen based platforms on the exchanges. Fine. So currently right now we follow a T plus 1 trading cycle. That is, T is nothing other than your transaction day, and your T plus 1 means plus 1 day for your trading. But SEBI has rolled out T plus 0 settlement for 25 companies alone. All right. So a little bit on this. Okay. Now, one thing you need to know about dematerialization is that one benefits of dematerialization, it's efficient, it has it can be easily traced, it's easy to trade, and it's anonymous. If I'm selling shares, nobody knows who is really selling, and if I'm buying shares, I don't know who I'm buying from. So there's a lot of anonymity, but it's also very efficient in nature. Dematerialization earlier was not compulsory, but slowly now it has slowly become compulsory. So is dematerialization applicable only to listed companies? No, it is applicable to listed and public, unlisted public, as well as private. Please keep this in mind. Demat is applicable to listed, unlisted, and private companies. Okay. Now, for all listed companies, it is compulsory to do dematerialization of shares, especially if your securities are listed on the stock exchanges. Then the promoters, the directors, the relatives of promoters, everyone's shares should have been dematerialized. Okay, this is what Regulation 40 of SEBI LODR states. But then for unlisted companies, SEBI does not apply. So unlisted public and private companies, SEBI does not apply. So then what does apply? Your Companies Act applies. So here the Companies Prospectus and Allotment of Securities rules, Rule 9A and Rule 9B. 9A applies to unlisted public companies, 9B relates to unlisted private companies. So what is it saying? It's saying that every unlisted public company shall issue securities only in the form of dematerialized mode. Any offer for issue of bonus shares, rights issue, transferring the securities, also everything should be in demat form. And unlisted private companies, the same rule applies. Now interestingly, for private companies, they've only said certain classes of private companies. Okay, whereas for public companies, they said every unlisted public company. So keep in mind one thing: every listed company, every unlisted public company has to do a dematerialization of their shares. But then for private companies alone, only certain classes are required to do it. So small companies are actually not required to dematerialize their shares. Okay. The next is the different types of market participants. You see, our stock exchange is not the only entity involved in the actual transaction of securities. We have market intermediaries, and we have a whole chapter that we're discussing this in chapter number 6. So we're going to come to this a little bit later. Okay. We have stock exchanges, we have depositories, we have depository participants. What is a stock exchange? It is a market for buyers and sellers. What is a depository? A depository is nothing other than, yes, it's a depository is like what you have as a bank account for your shares. So just give this a minute. I think it's loading. Yeah. So we have depositories in the sense like how we have a bank account for our money. Okay, we will have a depository for our dematerialized shares. And just like we have two stock exchanges in our country, we have only two depositories in our country. What are they? NSDL and CDSL. National Securities Depositories Limited and the Central Depository Services Limited. Two depositories. The interesting part is, okay, are the individual investor or your brokers or whoever it is supposed to buy and sell from a depository. Is supposed to buy and sell from a depository, because when we study Depositories Act, that's what it says. But then interestingly, the law does not allow for it. The law says that you deal with someone who's known as a depository participant. The depository participant will have to be registered with the depository. Okay. And all your transactions between the individual and the depository happens through someone that is known as a depository participant. So that is what we call a depository participant is merely an agent of the depository, and investors, if they want to deal with the depository, they have to do it through a depository participant only. Then we have trading members, we have stockbrokers, we have sub brokers. These are all your intermediaries. Again, like I said, we're going to be looking at them when we come to our chapter number 6, that is intermediaries. We have custodians, clearing corporations, etc. Now come to different types of instruments that we have in our in what do you say, in the stock market. Now in chapter number 1, you would have noticed that we would have studied capital market instruments such as equity shares with differential voting rights. These are the different kind of securities that can be listed on the stock exchange. Apart from that, apart from your equity shares, apart from your debentures, apart from your convertible securities, apart from all of these, you have certain types of um, certain kind of instruments that you can actually trade with in the stock exchange. One of them is known as an exchange traded fund. So what is an ETF? An ETF is actually what we call as an index fund. It's similar to an index fund. So now we have to ask, ma'am, what is an index fund? Okay, an index fund basically, we'll come to this a little bit later, but an index fund is something that actually tracks a particular activity. So we have the Nifty 50, we have the Sensex. These are all what we call as index funds. Now, an exchange traded fund, what it does is it takes like a bunch of assets, like, your equity shares, your commodities, your bonds, your indexes such as Nifty 50, Nifty 100, your Sensex, etc. And then it just tracks the performance of that index. So ETFs merely reflect the performance of the index that they track. So in the sense that, okay, fine, if we look at our Nifty 50, it will be trading at, let's say, 50,000 rupees or 75,000 rupees, or we'll have a Sensex of a similar amount. Then, in that case, this ETF will be tracking that amount as it goes up and down. So, what does this ETF track essentially? ETF can track, there can be equity, there can be bonds, there can be commodities, etc. Okay, and these ETFs are like your mutual funds. I buy units of it and then it can be traded easily on the stock exchange. Very, very high liquidity, and it has much lower fees as compared to mutual funds, because mutual funds will take money from you for managing the fund. But here, ETFs, you don't need to do anything. If the Sensex goes up, this ETF should go up. If the Sensex falls down, the ETF should fall down. Nifty 50 goes up, this should also go up. So it's just like constantly looking and saying, oh, you're moving forward, even I'll move forward with you. You're moving backward, I'll move backward with you. There's not much to manage over there, and so therefore there are lower fees there. The next is we see something known as derivatives. Derivatives derive its value from an asset. So, what are these assets? They can be different types of assets. They can be currency derivatives, they can even be commodity derivatives. Okay, so commodities is what? It can be like sugar, steel, copper, it can be gold, silver, wheat, cotton. These are what we call as commodities. Okay, commodities can include like oil, gas, metals, agricultural products, minerals. It's a huge market. Now, let's say we have the price of gold. Gold is trading at around, I think, 15,000 plus today per gram. Okay, now my financial instrument which I call as a derivative is merely a paper. This paper has the same value as that of the gold. So gold price goes up, my commodity derivative goes up. My gold price comes down, my commodity derivative should also come down. Same way for currencies. You see, currency derivative, now, what does it derive its asset from? From currencies. But currencies will always be in a pair. It will be like USD to rupee, or it will be from rupee to the pound. It's always in pairs in terms of currency derivatives. So what are they? The buyer and seller basically exchanging the currencies. The underlying asset will be the USD, or the INR, or the Chinese yuan, something like that. Okay. Now, what exactly are these derivatives? Derivatives are basically, they can be, without having to actually transact in the physical securities. You're creating a financial instrument from the asset, and then you're trading in that instead. It's a lot safer, it's a lot easier, it is faster. We don't have to worry about physical transfer of the actual securities. Then, friends, we come to another topic that we call as rights entitlement. You see, for rights entitlement, we need to understand, we need to go back and try to remember what is a rights issue. Okay, for a rights issue, we basically give what? We give shares to the existing equity shareholders. That's what a rights issue is. Now, rights issue, always under the Companies Act, if we have to recap it, it is given to existing shareholders, correct? So, actually, let's write that down over here. Okay, so we have rights issue. What is the rule about rights issue? It is given to existing shareholders, correct? Now, if your existing shareholders are given in a particular ratio, now if you're having 10 shares, then you'll be given one extra share, or if you're having one share, then you'll get 1:1 ratio, something like that. And then the thing is that, in terms of rights issue, there's something known as a renunciation, the right of renunciation. which the shareholder is allowed to do. So imagine that a rights issue is being given by the company and I'm an existing shareholder. How many shares do I hold? I hold 1,000 shares of the company. Now, what they for these rights issue, please understand it's not bonus issue. So I need to pay for the rights issue that they are giving me. They're saying that you'll get rights issue in 1:1. So I'm entitled to around another 1,000 shares, right? But I don't want these 1,000 shares. What I can do is I can renounce it. I can either renounce this in favor of another person, in favor of some individual, or I simply renounce it and then the company can a company can allot to whoever they wish. Company allots to whoever they wish. Now this renunciation can happen in part or it can happen in full. This is how renunciation takes place. This is coming from a company law perspective. Now, what the rights shares are different from a rights entitlement. Rights entitlement is saying that i'm I'm entitled to the rights shares in the future. So right now I will, like, let's say one rights entitlement is equal to one rights share, that is one equity share. But the difference is that for this equity share I have to pay the money for it. Okay, I have to pay so that it is allotted to me. Correct. But you see, the problem is the minute the company gives out rights issue, I'm not very happy with the company. So I'm like, okay, you're taking all this money, you're raising all the capital, but the company is not doing very well. So the company is like, okay, fine, I'll give you something known as a rights entitlement. A rights entitlement gives me an option to purchase in the future. So let's say at the time that the company is issuing the right share, the price of the shares of the company is at, let's say, 200 rupees. Okay, and the company is telling me that when I purchase these equity shares, I can pay 180 rupees for it. So already the price is a better price for me because I'm going to be paying 20 rupees lesser than what anybody else has to pay on the securities market. Now let's say that after 6 months what happens is that either one of two things will happen. The price ends up going to 240 rupees. 240 rupees. Okay, so that means the price of the share has increased. But how much will I have to pay for an individual share? I'll have to pay only 180 rupees. So 240 minus 180 rupees is basically I'm getting a 60 rupee discount. And in this case, what I will do is I will exercise and buy my right shares. I will exercise and I'll buy it, because remember, this is the option to purchase in the future at a predetermined price. But then let's say after 6 months, instead it comes down to 160 rupees. But then how much do I have to pay for it? I have to pay 180 rupees for it. Why should I do that? I'm at a loss of 20 rupees. So in this case, no exercise will happen. No exercise. Or I can either choose not to exercise it, or I can simply renounce my shares. I can announce it in favor of someone else, or I can just simply say, I don't want my equity shares. Friends, this is only your rights entitlement. It is given to existing shareholders to subscribe, eligible under the rights offer. Okay. And what they're saying is that the equity shareholder can apply for their right shares to the full extent. So let's say that I'm getting 1,000 shares. Okay. So let's remove this. So I'm getting 1,000 shares. I can choose to apply for the full 1,000 shares. I can apply for the full extent of rights entitlement plus additional equity shares. I can apply for, okay, I want 1,000 equity shares plus another 500. So if someone else is going to renounce it, then the company will probably take that and give it to me. Or I can apply for only a part of it and the rest in terms of rights entitlement. Or I can just renounce the whole thing in full. Now, what is the manner of doing this market renunciation? Remember, all my equity shares are now in dematerialized form. I can't exactly renounce it using my physical shares, etc. So they're saying that either what I can do is I can do it on the market or off market. On the market means that I'll do it through the stock exchange, whereas my off market is basically through my depository participant. Remember this. My off on market is through the stock exchange, whereas my off market is through my depository participant. Okay. Now, this is how exactly rights entitlements work. Rights entitlement are important for understanding your ICDR chapter and chapter number 8. Fine. Let's move on. Trading platforms in India, we have the main board platform, we have the SME platform, okay, and then we'll just look at the different types of platforms. NSE Emerge Innovators Growth Platform. Okay, friends. So one more thing is that all these platforms, the criteria for listing, etc., we're going to be doing in chapter number 8 properly. So I'm not exactly covering this in chapter number 2. This also includes the social stock exchange. My fair thing to you is that please study all these concepts in chapter number 8, because you're not only studying about the platform, but you're studying the eligibility criteria, who can list their stocks over here, who is disqualified, what are the additional criteria. All of that you'll be studying in chapter number 8. Once you finish that, come back to this chapter and look at all the different type of platforms. See, in types of platforms, we have the main board platform, which is where mainly like all your companies would choose to get themselves listed. But then some companies, which we call as the SME platform, small and medium companies exchange, essentially, we have the SME platform. We have the NSE Emerge Innovators Growth Platform. We have the Social Stock Exchange for you. Okay, these are what we call as the different types of platforms. Now let's move ahead. What do you mean by a margin? A margin is basically an advance money that you're getting for your stock transaction. So as you can see on the screen before you, I want to purchase stocks worth 1 crore rupees. Okay, but I own only 10 lakhs. The remaining 90 lakhs will be given to me as a margin. So what is this margin? It's a credit that's given to me. Credit means what? A kind of a loan. Who is it given by? By the broker or some other lender. Now, what am I doing is that I invest 1 crore, out of which only 10 lakhs is mine. The margin is 90 lakh rupees. Why am I investing this? Because I know that the stock is going to appreciate to 1.2 crores. So now what I'll do is I'll return this 90 lakh rupees to the broker or the lender. And then what will I get? I get my 10 lakh rupees back plus a 20 lakh rupees in profit. This is why people will do margin trading. And buying 1 crore shares, I mean, I don't have 1 crore with me. I own only 10 lakhs. And so my profits on the 10 lakhs is much lesser. And many of these brokers know, they're like, okay, this person is going to execute this trade. I'll lend him money for the time being. So this is what we call as a short-term credit. It's a very, very short-term credit. And that's what we call as margins. Margin trading is in two phases. One is the initial amount. So let's say my initial purchase amount is 1 crore. So then they'll give me a margin on that initial amount. Okay, just give me a minute. It will just settle back. Yeah. Initial amount is calculated as a percentage of the transaction value. So percentage of 1 crore rupees. Okay. Now this will be determined based on the broker and how much he can actually advance to you. Now let's say that I want an additional amount of money to maintain my stock. Like I want to maintain my position for as long as I can, I can get that particular profit. This is what we call as a maintenance margin. So this will be calculated as a percentage of the market value of the securities. Because remember, from 1 crore was my initial transaction, it might have already gone on to 1.2 crores. So now I want to wait until it touches 1.5 crores. So I can get an additional maintenance margin, which will again be determined by the broker. But this time it will be a percentage of what? Or not of the transaction value, but of the value of the securities. Because now it can be a higher value or it can be a lower value. Okay. So always remember, margin, there's initial and there's maintenance. Initial is a percentage of the transaction value, whereas maintenance is a percentage of the market value of the securities on the closing day, or I mean the on the closing price on that trading day. All right, fine. Next we have block deals and bulk deals. Block deals are basically deals that are happening in like big sizes. We're talking about each deal being 25 crores or more, because the minimum size of execution of trades in block deal is 25 crores or more. Now we already know If you execute trades of such large value, the price will just shoot up like that. Someone sells 25 crores of shares, the price will shoot down like that. And this will cause market uncertainty. So, what the stock exchanges allow is they allow a morning block and an afternoon block. Morning block is right before the market opens, before 9:30. So, from 8:45 to 9 a.m. And the afternoon block window is between 2:05 p.m. and 2:20 p.m. So, it's a total of 15 minutes that people are allowed to actually execute large trades. Okay. Whereas, what do you mean by bulk deals? Bulk deals is basically we want to know if a person is executing a trade more than 0.5% of the total equity shares. Now, a company can have 5 lakh crore equity shares or 50,000 equity shares, doesn't matter. A person who's trading in more than 0.5% of it is basically doing a large trade. Now, calculate this way: if a company has around 1 lakh equity shares, okay, calculate into 0.5%, nothing other than 500 shares. Now, public companies are not going to have only 1 lakh equity shares. Okay, now just imagine this becomes 10 lakhs, okay, and then that becomes 1 crore or 500 crore equity shares. Who knows, the number of shares will keep on increasing, and this becomes what we call as large values. So let's just take, for example, we just increase this from 1 lakh to 10 lakhs. This has become 5,000 equity shares. The same things become 1 crore, 50,000 equity shares. Now the value of these shares can move the market up or down. We call these as bulk deals. Now try to understand, bulk deals merely need to be disclosed. Bulk deals merely need to be disclosed, whereas your block deals, there is no requirement for disclosure. Please understand, this is not for disclosure. It's saying that you can do a block deal during this time. For 25 crores or more, you can execute these kind of orders. But then for bulk deal, it needs to be disclosed to the stock exchange. So then if you need to disclose it, who has to disclose? Is it the company itself? No. They're saying the broker should disclose. Okay, the name of the client, how many shares he's selling, the quantity of shares, and how much was traded on that day, he has to inform. So let's say, for example, that this person is executing 0.7% of the equity shares, and the broker has to inform it. Then what will happen is that the stock exchange will give this information to the general public after the market hours on the trading day. Because like, as a retail investor, I want to know who's buying and selling shares of the company. All right, fine. Then we have stock market index. Okay, so indexes, we've already discussed it a little bit. Indexes can basically track financial commodities. It can be like, okay, index is basically what is created by uh, the most important ones, at least, are created by the stock exchanges. So with respect to BSE and NSE, we have two different indexes that we have. What the stock exchange does is it takes like 50 top most important stocks, okay, that represent that full sector or that full category, or that full, like, let's say, large cap or mid cap or small cap. Okay, and what it does is it tracks the movements of this. So by looking at an index, I know if that full sector is doing well or not doing well. So therefore, it what does an index do? It tracks the price movement. That's the first thing it does. Of what? Of financial products, of commodities, of currencies, of the different things, assets that we have on the stock exchange. So what the stock exchange will do is it will create a group of stocks that represent the whole market or that whole sector. So we already know if the Sensex is doing well, we know the entire Indian stock market is doing well. The Sensex is going down, we know that the stock market, the whole India is affected. But then if you look at, say, Nifty 50 in banks, or like a bank stock, then we know that the bank sector is doing well or is not doing so well. So like I said, we have something known as the Nifty 50, then we have the BSE Sensex, and then we have like different things, okay, Nifty Auto, Nifty Bank, Nifty FMCG. These are what we call as different sectors. Now, how exactly do they choose which is the 50 best stocks? Is it like who has better revenue or who has better what? They are chosen on the basis of market capitalization. Okay, market capitalization. So now when you take a look at how exactly they calculate this Sensex and your Nifty, the basis, they're basically saying that it's done through something known as a free float method. Now, please understand, Sensex has come into existence far before your Nifty. So the value of your Sensex is much, much higher than your Nifty. Now, what exactly is this free float method? Is that it checks how many shares are readily traded in the stock market. Because sometimes as investors, I won't press the buy order and I won't have any shares that I can buy because nobody is willing to sell. But then if I have to go and buy, say, Tata Motors shares, it's just freely available for trading in the market. Now, it's not just like readily available. It's just that some stocks will have readily available for trading, some stocks will not have. So what Sensex does is it calculates, okay, fine, if how many shares of this company is freely available for trading in the market. Now, please understand this: these shares don't include your promoter shareholding, because promoters will always keep their shareholding with them because SEBI requires it, or your SEBI regulations require it. Or there'll be something known as locked-in shares. It can be because of ESOPs. It can be multiple reasons where the law is coming and saying that look, buddy, you can't trade in these shares over here. So the free float method discards these and checks how much is being freely traded. Okay. Now, one based on that, they take those companies which are in the top, like let's say 50 or top 100, and then they'll put them together, and then that's what we call as the Sensex. But then another one is the market cap method. Market cap is basically the total value of the company's stocks, whereas the outstanding shares for trading in the general public is known as float. So free float is how much is available for trading. Market capitalization is the value of the stock. Market cap is value. Free float is free for trading. All right. Now, the market cap is taken into account. It is done by multiplying all the shares issued by the company with the price of the stock. So if there are 1 crore equity shares and the stock price is 100 rupees, then that is your market capitalization. Whereas BSE determines your free float method is a multiple of the market capitalization of the company. Okay, so this is a technical method used for doing that. Whereas your Nifty is basically a market indicator for NSE. Your Sensex is for BSE, Sensex, BSE, whereas your Nifty is for NSE. You can remember N for Nifty, N for NSE. Okay. Now, this is also calculated through the free float capitalization weighted method. And here also what they do is they basically take the current market value, free float capitalization, divided by the base market capital. What is base market capital? Basically, they're saying that we have like a base index known as 1000, and then this is the calculation that we use for calculating the Nifty. Fine. Okay. So now that we've understood Nifty, we've understood Sensex, what is free float method, what is market capitalization method. Okay, now let's move on. Some basics of investing. See, basics of investing is that always be careful. Simple as that. But then when we're investing, what should be careful? What should we be careful about? I enter a market and I'm like, oh, Tata Motors, it must be a good company. I shouldn't think of it that way. I should look at the systemic risk and the unsystemic risk. Okay, because let's say, for example, there's a war that's happening in US and Iran, between the US and Iran. That time my textile industry might be affected, my what do you say, my gold industry can be affected. These are all the different things, whereas each sector can face uncertainty due to multiple reasons. Inflation is always a risk. Then there's volatility, there's currency risk. If, let's say, because of the Iran and US war, lately our rupee has been falling. Like we've hit record lows of 96 rupees for $1. That is record lows. Like we've never seen this come this far. That is what we call as currency risk. Currency risk can affect inflation risk. Inflation risk can also come from unsystemic and systemic risk. These are all the different risks that we have to keep in mind when we actually deal in the stock exchange. Fine. What do I need for investing in the stock market? First, I need a PAN card. Okay, always remember, I need a PAN card, because when with a PAN card only I can open my demat account. Then I also need a bank account linked to my demat account. Demat account is for the purpose of holding my dematerialized shares. Then what is a trading account? Trading account is kept with brokers only. So if you look at it, I have a demat account with Zerodha, or you can have Grow for better examples. Whereas a trading account I can have with maybe Kotak Securities, or I can have with ICICI Securities, something like this. Fine. So these are the requisites for me to actually start trading. Then role of clearing corporation, will come to this eventually. Market surveillance. Market surveillance is basically the role of both SEBI as well as your stock exchange. How do I know? How does the investor know if a let's say a stock is being manipulated? Because every day there are, I can say, lakhs and lakhs of contracts or securities that are being traded in the stock market, right? So, how do we know that one is being manipulated or the other one is being done properly? This is the role of SEBI and of your stock exchanges. So, we call this as global market surveillance, wherein they will implement two types of surveillance, both online and offline. Online surveillance basically is like literally neck to neck. Immediately they'll be able to find out if there's some kind of abnormality in the stock, what do you say, in the stock movements. So what they'll do is they'll maintain something known as a price band. Now let's say that the company opened at 100 rupees and it's gone past 1000 rupees in the same day. So that means somewhere it's gone beyond an exceeded limit. So the stock exchange will be looking, is the price exceeding 10% of where it opened? Is it exceeding, what do you say, 20%? Anything beyond 20%, there's some kind of fluctuation happening over here. Instantly a notification will go out to everyone saying this is under surveillance. Whereas dynamic price bands is basically, okay, fine, let's say a stock closes at a particular rate on the previous day and it will open at a different rate on the next day. We can't really do anything about it. But is that difference very high or very low? Is there manipulation? So dynamic and fixed. Whereas offline is what we call as the proper investigation method, the company's reporting. Then normally itself we have something known as a surveillance framework. Okay, so SEBI will give out something known as GSM and ASM measures. If you're an investor in the stock market, when you open out certain stocks, it will clearly come over there, GSM and ASM. GSM is basically your your graded surveillance measure, and then ASM is additional surveillance measure. So GSM, basically what they're saying is that depending, like, there's a sudden price movement, okay, but that price movement is not relating to any activity of the company. Like, let's say the company has posted financials, and in the financials there is profit. Because there is profit, there is an increase in price. This makes sense, right? There's no reporting, there is no financials, nothing, and then suddenly the price of the shares is going up. It's not commensurate with the actual fundamentals of the company. So that means someone's manipulating it. Whereas additional surveillance measures is basically, okay, certain extra activities. Okay, it's like certain parameters, like, is there sudden increase in volume but there's no price movement, or there is a sudden price movement and there's no trading happening. These are things that we'll call as graded and additional surveillance measures. All right. Okay. And finally, we come to our last topic, that is the impact of your Fed policy and your credit policies in our country. So Fed policy is basically relating to the United States. How does United States affect us? You see, the Fed policy relates to the Federal Reserve. This reserve actually lends to the US banks at a particular rate of interest. And then these US banks will then lend to the individual customers. So what happens over here is that when the US banks, when they increase this rate, the banks will also have to increase the rate of lending to the investor. So what ends up happening is that the price of lending increases. Whereas if they reduce the federal rates, obviously the money that is going out to the consumer, it also, what do you say, the interest rates also come down. So what they say is that the US Fed rate, how can it actually impact India, is that if Fed is increasing the interest rates, lending rates for companies and retail borrowers will go up. Okay, and instead, and when that happens, what ends up happening over there? People will stop borrowing from financial institutions in America. Then what will they do? They'll come to India, and then they'll start parking their money over here. But then the minute the Federal Reserve reduces the rates, people will remove money from India and then they'll go off into the US. So essentially, what ends up happening is that the US increasing this rate or reducing this rate encourages the flow of money or like out of the country or back into the country. And this is how it can actually affect India. And if you look at our own credit policy of RBI also has a similar policy. We have RBI who lends to banks. Okay, we call this as the repo rate, and then the banks will give to the individual customer. Now the purpose of RBI and maintaining this monetary policy is basically to encourage economic growth, stability of price. Lately it's not been happening, but one can argue it can be because of government policies, it can be because of wars, it can be about economic situations, but it's RBI's role to actually maintain rate stability, price stability also. That is, if we're talking about in terms of inflation. 10 years ago, if I had 100 rupees, I could buy, let's say, 10 chocolates. But then the same 100 rupees today, I can buy only 5 chocolates. That is what inflation is. So it is the role of RBI to actually maintain the price, which we call as inflationary measures. Okay. The credit policy of RBI, they have something known as a repo rate and they have something known as a reverse repo rate. What did I say? Repo rate is basically when RBI lends money to your banks, to your credit co-op societies, your different NBFCs, etc. And then what they will do is they will lend money to the investor. This is known as the repo rate. Whereas the purpose of repo rate is to encourage like more and more money in the market. Whereas reverse repo rate, basically what happens is the opposite. Now RBI will take money back from the banks to reduce the amount of money in the market. Now, why do you want to reduce money supply? Simple. If there is lower demand and higher supply, what happens? The price comes down. Whereas the same thing is if there's high demand and there's less supply, what happens to the price? The price goes up. Simple economics, right? So when there's too much money supply in the market, the price of our rupee will come down. Whereas this is what the reverse repo rate is. The RBI is taking money back from the market. Now, to ensure that banks don't simply take deposits and then fail and then close down, etc., the RBI is implementing something known as a cash reserve ratio and a statutory liquidity ratio. What does this mean? Cash ratio, CRR is basically they have to deposit some cash deposit with RBI, whereas statutory liquidity ratio is basically one amount of money that it has to keep with itself. And there are actually punishments if the company tries to use its SLR funds without permission of the RBI. Okay, so then we look at standing deposit facility. It's again to encourage what do you call encourage a sort of stability in all in the money market in India. Then, like I said, if the companies end up taking money from their statutory liquidity ratio, the the RBI will impose a punishment on these banks, saying that look, you have to pay an amount for taking money away from that SLR, and then the banks will actually have to replenish it back so that the SLR is maintained properly. Then we have a liquidity adjustment facility, which is basically nothing other than maintenance of your repo and reverse repo rate. So these are the different kinds of policies that we see under RBI. And after that, we have what we call as your inflation indexes. This helps us to track how much inflation is there in the market. So two indexes we actually see. We see something known as a CPI and a WPI. CPI is your consumer price index and your wholesale price index. And what do they essentially do is that wholesale price index was implemented in the year 2004 2005, wherein they calculated this as the number 100 base price. Okay, now this will keep on increasing. So how much it increases shows us how the wholesale market is indicative of the economic growth or the inflationary market in our country. So right now they're saying that the base year for CPI, that is your consumer price index, is 2012, whereas for WPI it was 2004 2005. So WPI started way earlier, whereas CPI was introduced only in 2012. Okay. Now, what do you look? In CPI, it includes 448 rural and 460 in the urban. So these are the different items that they take to check how much inflation it's costing. So let's say I wanted to buy one egg. Okay, one egg. Earlier I had to pay like some 50 paisa for it. The same one egg today costs around 7 rupees, like 5 to 7 rupees if I'm not wrong. This is how I check the inflation. And if you look at WPI is the wholesale price for all your basic items like fuel, your salt, jute, cotton. These are the different things which we call as what is the cost of wholesale, what is the wholesale price. Whereas your consumer price is basically how much the consumer is paying for it. Because a wholesaler, if I have to go and buy chocolate in wholesale, okay, if I have to go buy chocolate in wholesale, I'll probably get it at 300 rupees per kg. But then as a consumer, if I have to go and buy it from the shop, the same chocolate will cost me 450 rupees. There's a difference between the wholesale price and there's a difference between the consumer price. Consumer CPI covers only consumer goods, whereas WPI covers all goods, including intermediate goods transacted in the economy. WPI weighs national accounts, whereas CPI is only determined based on consumer expenditure. So that's what I've written over here: the lipstick expenditure, the brownie expenditure. There was a calculation that went on to say that if a person is spending so much on buying lipsticks, okay, then there's more money in the market. But then if you barely have enough money for your basic items, you will not be buying cosmetic items. And now, admittedly, this index can be taken with a pinch of salt. Okay, and we'll say that this even applies even for your brownie index. Okay, this is just some tracking measures that they keep in mind. Obviously, it doesn't tell us the whole health of the economy. Okay, so friends, with this we actually come to an end of our chapter number 2. All right, so this was a full recap of chapter number 2. Let's just take a look at the question bank. Okay, so chapter number 2, very very important, because look, you can expect anywhere between close to 5 marks to even 20 marks from this particular chapter. You have to be ready for both of them. They can ask simple questions which will be great for you, or they can ask like how in December 2024 and in June 2024 they have asked enough questions. All right, so expect a good number of questions to come from this chapter. It's a very easy chapter, it's very easy to write, unless of course they've given like a comprehension style over here, in which case you'll be required to think. So try to like study some of the important points, a few numbers. Like say in June 24 they asked about what is a block deal, and what are the type of surveillance restrictions. Very simple concept, and it's only 2 marks each. Okay, so like this, this is what we can expect from our chapter number 2. Let's start out with our chapter number 3. What do you say, chapter number 3, 4 and 5 subsequently. Okay, so friends, we're starting out with our chapter number 3. Chapter 3, 4 and 5 I'm going to do very quickly, very fast, because there's a lot of common concepts over here. We'll take a look at it from your examination point of view, okay, how they've asked out over here. So a question bank. So some of you have been wondering like how exactly you need to, you can access these question banks, etc. Let me just show you like what I'm referring to. Friends, we have a website that is known as csmentor.co.in. It's a very simple website. You can just follow the website that's given over here. It's even there in the link below, so you can always refer to it. Now we have both a mobile app as well as a website. So simply go over here, and then if you go to courses, okay, we have all the courses which are completely provided. So our recorded classes we have for individual subjects, as well as for, yeah, we have combos for module 1, module 2, as well as we have individual subjects also. Now at this point we have for capital markets. If you go into the capital markets, you'll have classes which you all can access for a 1 month validity, 2 month validity, and a 3 month validity. Okay, I would love to hear your comments if you would like it for a higher probably a longer period, but I think like 3 months time is sufficient for one subject. Additionally, if you want, let's say if you want to take out a combo class, okay, let's take a module 2 combo. The module 2 combos are basically available for 6 months, 7 months, and even 1 year validity. So you can refer to all this over here. Now if you take a look at our our classes, we've provided it in such a structured manner. Like, take a look at our content, and I have provided for you, like, this is for the combo classes, okay? We have for CMSL and we have for ECIPL. Now, what I've done is, like, let's take out CMSL. The question bank is provided over here. I'll open it up for your viewing. Anybody can view this over here, but you're required to go into the app, you're required to log in, and then you can view all of this on your own. Now, let's say, for example, you can purchase the classes. Let's say an individual class. So this, I've taken out the combo at this point. Give me a minute. So let's say that I want the CMSL classes. I simply go over here and then, like, look at the content. I have provided all the notes, the classes. The classes are provided in, like, in such a structured manner. Like, whether it chapter wise, I have given everything. And if you want to access these classes, 1 month, 2 months, and even 3 months are provided for you. So definitely go and check it out. Don't hold back for anything. I've done such a detailed, good explanation of all the notes of all the chapters. I've even provided, like, certain question answers for you to, like, refer to through this question bank. And definitely check it out if you want, and it will be very, very helpful for you for your examinations. Okay, so now that I've shown you all of this, one more thing, you can see these classes in your mobile app also, which is going to be very convenient for you at the time of your studies. So let's come back to our studies itself. Let's start out with our chapter number 3, chapter 3, 4, and 5. Okay, so chapter number 3 is nothing other than your Securities Contract Regulation Act. So what is your Securities Contract Regulation Act? It is purely to govern, sorry, it's purely to prevent fraudulent or illegal transactions in the securities market. So it is to prevent, and it is to regulate what? All your stock exchanges, all your contracts and securities, how companies list themselves on the stock exchange. So this Securities Contract Regulation Act has to be read with your SCRA rules. These rules are very important. We'll be taking a look at rule number 19, 19A at the very end of this chapter. So what exactly do these rules provide? They provide the procedure of how stock exchanges can be recognized. So we have only two stock exchanges that are running now with national, what do you say, national platforms. Now, the process of recognizing them is through your SERA. Then, filing of returns and annual reports and inquiry. That's one of the main things. Then, apart from that, we have some additional regulations also which are provided. SCRA does not apply to government, RBI, or any authority governed by special law. So that's like your LIC, ONGC, etc. Does not apply to convertible bonds, share warrants, options, or rights. As regarding the conversion of these particular securities, if the price was already predetermined at the time of its issue, and then the government can basically classify any set of securities that the provisions does not apply to. Fine. Now, coming down to definitions, key definition is securities. Let's quickly go through it. Securities includes shares, scrips, stocks, bonds, debentures, debenture stock, any other marketable security. What do you mean by marketable security? It must be transferable in nature. Derivatives, units of a CIS, security receipts, mutual fund units, units of a pooled investment scheme. Then we have any instruments given to, by to an investor by an issuer for a special purpose distinct vehicle, government securities, or any other rights or interest in securities. Okay. Now, coming down, recognition of stock exchanges, we basically see section 3, 4, and 5. Section 3 talks about how you need to make the application. So application, basically they're saying that first give a copy of the bylaws. These bylaws are important, and a bunch of rules of this particular stock exchange. So who is the governing body, like who are your officers, what are their powers, functions, and duties, how do they qualify, will they be suspended, expelled, etc., and how will they enter into partnerships, and how will they appoint authorized representatives, clerks, basically like a governing set of rules. Okay. Now, if like SEBI with the central government, they'll basically look at it, and their main criteria is, look, listen, if I grant you stock exchange, recognition, you have to protect your investors. You have to ensure that there's fair dealing. So show me that you can ensure these in your activities. And if the stock exchange complies with it, then they will be granted recognition for the same. Now, obviously, we'll be taking a look at the qualification of membership of stock exchanges, how contracts will be entered into, and since it's such an essential element of our economy, three members will be nominated by the central government, and all the accounts will have to be audited by the chartered accountants wherever the central government requires. Now, if like stock exchange has to be not removed or something, but basically they're saying that for stock exchanges recognition has to be withdrawn, then yes, a notice will be sent to them, opportunity of being heard, and then basically their recognition will be removed. Now, the concept of corporatization and demutualization is a mandatory thing for stock exchanges. So, for stock exchange has not been corporatized or demutualized, immediately it will stand, the recognition will stand withdrawn. Now, powers under the SCRA, we have powers of your central government, we have of SEBI, and then we have of the stock exchange. So, when we take a look at the central government's powers, they basically two for periodical returns and for making inquiries. So, what will they do? They will, how do you make periodical returns? Basically, they're saying that maintain your books of accounts for 5 years. Then, if necessary, the stock exchange, the director, managers, employees, members, partner, manager, secretary, everyone are bound to provide information to the central government. Okay, then central government has the power to make rules. It can even supersede stock exchanges if they feel like it's being the functions of the stock exchange are being carried out in a wrongful manner. Then the central government can come forward and take over the activities of the stock exchange. It can even suspend the businesses of a stock exchange for 7 days in the interest of public interest, prohibit certain kinds of undesirable contracts or speculative contracts. It can even give protection if, for any kind of wrongdoings that the stock exchange has done, provided that they make proper and true disclosure. The government even has the power to grant immunity and then to delegate and make rules. So your central government has passed the has the power has delegated the power to pass regulations to SEBI or even RBI, whereas the rules will be made by the necessary authority. These are the only powers of the stock exchange, of the central government. What is the power of the recognized stock exchange? Stock exchange can basically restrict voting rights and to make bylaws. Now, what are they saying over here? Restriction to voting rights will basically mean that they can say that regardless of how much paid up equity you're holding in the stock exchange, you will have only one vote irrespective of your paid up capital. So, this right to restrict voting rights is given to the stock exchange. And then, even for making bylaws with the approval of SEBI, this is the power of your required of your recognized stock exchange. Then comes your powers of SEBI. Now, you see, SEBI is your regulator, so they will definitely have way more powers than just what the stock exchange is doing. Because remember, I'll always say this, okay? Your your stock exchange, your stock exchange is like your class monitor. Okay, they only have limited powers. They don't have a lot of power to do multiple things. Whereas your SEBI is your is your headmaster. Okay, and then you have your central government, which is only your central government is like your headmaster. My bad. Okay, your SEBI is like your class teacher. Okay, and then your stock exchange is like your class monitor. Class monitor cannot do much. Your class teacher knows everything about you and can punish you. Your headmaster will just come and check if everything is happening properly. This is how I look at SEBI, stock exchange, and your what do you say, and your central government. So now let's look at powers of SEBI. The bylaws that were passed by those respective stock exchanges, the SEBI has the power to come and say that amend it or change it or change it so that it can protect your investors. Okay, then issue directions under section 12A. Issue directions means what? In the interest of the securities market, for the protection of your investors. Then the power to adjudicate, basically they'll set up an adjudicating officer, and this adjudicating officer will be the one to hear disputes between investors and the and your stock exchanges, and to make regulations. Okay, SEBI is the one that passes all the different regulations that we're going to be studying about in part B of this subject. So it can amend the bylaws, it can amend or make or amend bylaws. It can issue directions in the interest of investors and orderly development of the securities market, to secure proper management of the stock exchange, so that nothing is happening detrimental to the interest of investors. Okay, then to make regulations, we already know all the regulations once made will be tabled before the houses of parliament, before the houses of parliament. And then adjudicating officer, they'll appoint an adjudicating officer, they'll have the power, or they'll give the opportunity of being heard and impose penalties wherever it is necessary, pass orders, and then this is what is required. So now when we take a look at your when you take a look at how securities, I mean companies will have to get themselves listed on the stock exchange, it's very simple. They have to first make an application to the stock exchange, and then only uh, send a letter of offer to the public for subscription. Because normally, please try to understand that for unlisted companies, we only do filings, in the sense that we send out the offer letter first, and then we do filings with MCA. Okay, this is how we do it. But then for listed companies, first you get permission before stock exchange. If stock exchange does not give permission, you cannot list your securities. Then and only then you have to send offer letter to the investors or to the public for subscription. Okay, this we'll take a look at much later. Now, from your adjudicating officer, you have the right of appeal. You have the right of appeal to your central government. Okay, so this is to the central government within 15 days of what do you say? Of the what do you say? You can go and appeal from the decisions of um, the actions taken to the stock exchange. Okay, now the stock exchange, let's say for example I want to list my securities, stock exchange comes forward and says you're not allowed to list it. I can go and appeal to the central government within 15 days time. Then beyond that, they're even giving the power to SAT. You see, SAT came much later, so now this power to the central government is no longer existing. We have to go to the Securities Appellate Tribunal. So the same way, if the stock exchange refuses to list my securities, I have to go within 15 days to SAT, and I can get an appeal done. Okay. Company secretaries can appear before SAT. From SAT, I can go and appeal to the Supreme Court within 60 days time. Okay. Then come down. Yes. Securities contract regulation rules. Now, this is the important part that I wanted you to keep in mind. You see, here we have to take a look at Rule 19.1. Okay, we have to take a look at Rule 19.2. Then we see Rule 19.2b, and we need to see Rule 19.3 and Rule 19.5, 19a. Now, these are very important. Okay, out of this entire chapter, I'll say these are your most important topics. Let's take a look at it. Your Rule 19 clause 1 is basically just saying that, okay, if a company wants to get itself listed on the stock exchange, the following documents will have to be given. What are those documents? First thing, MOA and AOA. Why? Because you're a company. If you're a trust, then if trust deed is applicable, you give trust deed in case you have debentures. All the documents, prospectus and statements in lieu of prospectus. Your have you offered or have you given securities to the public in the last 5 years? Give details of that. Balance your audited balance sheets and audited statements for last 5 years. Have you given dividends, cash bonuses? Have you failed to pay dividends? All of that also a statement has to be given. Certified copies between vendors, underwriters, brokers. Why? Because all these people are depository participants or market intermediaries, and you have to enter into agreements with them. Similarly, with selling agents, managing directors, general managers, all these agreements have to be brought in. Material contracts regarding the capital structure of the company. Have you increased your authorized capital? Have you split it? Have you made changes? Have you amalgamated? Have you reconstructed? Your shares, debentures already issued, and any kind of brokerage, commission, discounts, anything that you're giving with any person. Then in addition to that, rule 19.2 is coming in saying that look, when you come for listing on the stock exchange, make sure you've completed all like old activities, like ensure that all your shares are fully paid up. Make sure that there is a common form of transfer for all your shares, because in private companies they'll have different rules applicable for transfer of shares. Make sure there's only one form of transfer. There should be no forfeiture of unclaimed dividends, options, or right to call shares except in accordance with the general meeting of the company. Why? Because private companies, or when they're still unlisted, they might have specific agreements with their shareholders, or they might have specific rules in their AOA. All of that will now have to become brought into a common form of transfer, because now we won't be constantly getting permission from the company. It will just automatically happen in the stock exchange. So make sure that all unpaid amounts, your shares must be fully paid up. Common form of transfer. All your rights or your call of shares should be done only through general meetings of company, etc. Okay, and then this is the basic rule 19.2b. Okay, what is the minimum offer and allotment to the public? What is the minimum offer and allotment to the public? The general rule I will say is 25%. Okay, that's why I call this as the 25% rule. General rule is 25%, but there are categorizations based on what is the total amount of capital issued to the public. Now, I want you to remember it this way, okay? Capital, think of it this way: less than 1,600 crores, okay? Greater than 1,600 but less than 4,000, greater than 4,000 but less than 1 lakh crore, and greater than 1 lakh crore. Remember these rules. What are all of these numbers? This is how much capital is being raised from the public. The post issue paid up capital of the company. Sorry, not how much is being issued to the public, but after the public issue, the total paid up capital of the company is going to be 1,600 crores or less. If that's the case, rule 1 will apply to you. But no, after raising from the public, it's going to cross 1,600 into 2,000. So they're saying greater than 1,600 but less than 4,000. Then greater than 4,000, less than 1 lakh crore, and greater than 1 lakh crore. So less than 1,600, they're saying 25%. What 25%? 25% of the shares of your equity shares or debentures or convertible into equity shares should be given to the public. Public should be holding it. But then for greater than 1,600 but less than 4,000 crore, they're saying at least 400 crores should be with the public. So earlier it is a percentage, here it is a number. Now greater than 4,000 crore but less than 1 lakh crore, they're saying 10%. And greater than 1 lakh crore, 5,000 crore should be with the public. So let's repeat again: less than 1,600 crore, 25% with the public. Greater than 1,600 but less than 4,000, 400 crore should be with the public. Greater than 4,000 but less than 1 lakh crore, 10% with the public. Greater than 1 lakh crore, 5,000 crore should be with the public. However, first condition, however, all the companies in subclause 2 and 3 should increase it to 25% within 3 years. That's why I call this rule as the 25% rule, because even both these companies have to increase it to 25% within 3 years' time. And what about the company in 4 that is greater than 1 lakh crore? They're saying that they also have to reach 25%. Okay, but they're saying first reach 10% within 2 years, and then at least 25% within 5 years. So a longer time is given for companies with greater than 1 lakh crore in post paid up capital. Ultimately, they have to reach 25%. Simple as that. Okay, so this is what I call as a 25% rule. Then in addition to that, your 19.3 basically says there are certain additional conditions. All the allotment letters, all the rights, offers, all the distinctive numbers, everything should be given at the same time. For registration, subdivision, transfer, no fees should be charged. Everything should be, receipts for all these securities deposited for these should be done immediately without a charge. All the certificates for renewal, consolidation, split, letters of allotment should be given at the same time. certificates should be given within 1 month time. Stock exchanges should be notified anytime there's material changes. Stock exchange should be notified the minute there's changes in directors, auditors, when there's an AGM, EGM, all of these should be notified. Friends, these rules, no, will be seen directly through LODR, because LODR tells us that when these activities happen, these kind of notification should be done. You have to inform stock exchange, or you have to get permission from stock exchange and then do it. So these are what we call as additional conditions of listing. So that's why they say, as a private company, your compliances are much lesser than your compliances for listed companies. All right. Now, can your securities be withdrawn or suspended from the stock exchange? Definitely yes. A letter will be given, reasons, opportunity to be heard, and definitely it can be reduced. Now, here comes the minimum shareholding. Now this relates directly to the provision that we looked at earlier. There they're saying the minimum amount to be given to the public. So please understand, this rule is the initial, that is at the time of your IPO, the minimum offer and allotment. So the allotment can be given to multiple people. To the public, you have to give at least so much. So the same 25% rule is also applicable for the continuous holding. Continuous holding. Because I'll tell you what will happen. Company will issue 25% to the public, then the promoter will go and then he'll purchase all the shares from the public in the market. What is the logic behind that? Then your promoter is only holding all the shares in the company. So they're saying that initially you offer to the public, then after that, make sure that the minimum public shareholding shall always remain 25%. And what if it goes below 25% due to some reason? Bring it up to 25% within 12 months' time. So Rule 19a clause 1 says minimum public shareholding 25%. If it goes below 25% for any reason, bring it back up to 25% within 1 year's time. Okay. Then in addition to that, they're saying, what if a company was undergoing insolvency? So therefore, what ended up happening was the public shareholding came down. And no problem. Such companies shall bring back to 25% within 3 years' time. But then they're saying, okay, what if it falls even below 10% or less? They're like, first increase it to 10% within 12 months' time. Then I'll give you a total period of 3 years to bring it up to 25. All right. So this is the rule with respect to IBC. With IBC, they're saying that, okay, listen, if it falls below 25, bring it up to 25 within 3 years' time. But if it goes even below 10%, bring it to at least 10% within 1 year. Then I'll give you that additional time to make up for it. But then, due to some resolution plan under IBC, because IBC involves a resolution plan which can be implemented, they're saying that public shareholding should be at least 5% approved under the IBC code. Okay, so this is the rule with respect to that. For PSUs, there are different rules. PSUs, they're saying, okay, fine, PSU should increase to 25% within 3 years of commencement of these particular rules. And then if it falls below 25%, they'll increase it within 2 years' time. For normal companies, it is 12 months, whereas PSUs will have 2 years, basically a slightly longer period. Okay, this is what we call as the minimum shareholding requirement. I hope you're clear with this. Okay, and this marks the end of your SCRA. Now, friends, I just want to quickly go through your question bank, okay, for SCRA. Here, SCRA is slightly on the lower weighted side. As you can see, 5 marks. June 25 also 5 marks. In 24, they've asked question, but only 2 marks each. So short style answers. And then come to chapter number 4, SEBI. December 25, they've asked, okay, 10 marks plus 5 plus 5. So basically, they've asked close to 20 marks in December 2025. And in December 2024, they've asked only 5 marks over here. So weightage wise, I will say lower weightage, you can expect at least 5 marks from this chapter. Some attempts they've not even asked any questions from here. So concentrate on short style answers, because look at this: 1 1 1 plus 2, 5 marks each. That's all. sorry, 5 marks per question, or they'll ask some direct question like this. Fine. So this is for SEBI. Then the next chapter is your chapter number 5, depositories. Depositories and DP are a little bit important. As you can see, December only 1 5 marks, June is 10 marks, and June 24 again only 5 marks. So still on the lower weightage category. Expect at least 5 marks from this chapter. Direct questions, you don't have to worry about anything very specific. However, in June, can you look at it? They have asked 1 mark questions, but slightly on the practical end of it. Okay, so friends, we've completed our coverage of chapter number 2, chapter number 3. Let's come to the chapter which is your SEBI. Okay, now for SEBI, right, I'm going to concentrate mainly on like the introduction part, like the basics of SEBI and all. I'm going to leave it to you. I'm not going to be discussing this a lot over here because I feel like it's not too important. Generally, if you look at SEBI, it's to protect investors, to promote development in the securities market, and to regulate the market. This much we know. SEBI has been incorporated as a body corporate. Okay, so it'll have perpetual succession, can own property, can acquire property, can enter into contracts, etc. And the head office is located in Mumbai. So the management, all of that, I'm not exactly doing this through our coverage. Let's take a look at the functions and powers of SEBI. The section 11, as we can see, it's to promote, to protect, and to regulate. So how does it promote? It basically protects the interest of investors and promotes the development of the market. So it'll either regulate, register and regulate. So it's saying that if you want to deal in the securities market, first get yourself registered with me. Then it will promote certain activities. It will encourage for investor confidence or investor relations, things like that. Prohibit fraudulent activities, prohibit insider trading. And then it will call for information and do inquiries wherever necessary. And for the purpose of doing that, it can inspect books of accounts, and it has the powers of the civil court with this respect. So receiving documentary evidence, calling witnesses, inspecting books, records, etc. These powers are there with SEBI. Now coming down, section 11A is purely for investor protection. It can do this by passing regulations. So we have the FUTP regulations, we have the PIT regulations, all of these are there for investor protection. In addition to that, it can give specific orders to companies directly, like to one individual company. These regulations are applicable to all, everyone, whereas your general or special orders is individually to separate companies. Then it has the power to regulate collective investment schemes. It can issue directions and levy penalty. So issue directions means what? Issue directions saying that okay, these people are not supposed to do this. I'm going to bar you from the market, etc. So these directions are only issued in the interest of investors for development of market and to secure proper management of the intermediary. Now, what kind of directions will it give? It will say that, okay, whatever extra profit you made, or wrongful gain or wrongful loss that you made, you have to disgorge that amount. You have to give it back. These are some of the directions that it can give. Then it can conduct an investigation. So, for the purpose of investigation, what will it do? If it believes that someone's tampering with the market, it can definitely investigate the affairs of the broker, the intermediary, etc. Those intermediaries, like all of these people, have a duty to produce those books of accounts. And then the investigative authority will also have certain powers to go and to enter into offices, to call for information, to check certain accounts, etc. And custody, the books of accounts can be with the investigating officer for a total period of 6 months. Beyond that, it needs to get permission and then keep it. And after that, the orders can be passed, like in the sense that okay, fine, you want to enter into a company and seize certain things, to search and to seize. This can be given with the help of a magistrate or a judge. And then finally, orders can be given. So when you look at the types of orders that SEBI can give, it's not always to pay a penalty. If it's smaller violations, it will simply say cease and desist, stop doing whatever you're doing. This is a power that's given under section 11b. Okay, now friends, there is something known as penalties. Penalties, you'll notice that all the penalties are similar. So I would actually suggest that you study penalties which are slightly different in nature. Study those penalties alone, because everything else will have a standard penalty like this. Okay. Yeah, adjudication. So we've already seen this in the previous chapter. The power to adjudicate means that it'll appoint a division chief or an adjudicating officer. This officer will have the power to summon and enforce witnesses to come and to produce documents or evidence before him. And orders will only be passed after opportunity of being heard is given. Now, what factors will be kept in mind while imposing penalty? How much disproportionate gain or loss? What additional loss was caused to the investors? And how many times is it being repetitive? So, how many times are they repeating the same violation? Based on that, the penalty will increase or decrease. Okay. And then we have something known as administrative and civil proceedings. So basically, what they're saying is that for certain kind of penalties, they're saying that okay, fine, um, you can settle it, okay, by simply paying a particular fee. Now these fees, obviously, in the sense that it's like you're paying the penalty for it. No appeal exists from this these settlement proceedings. Why? Because you're settling. You're making sure these settlement proceedings are not adjudication. What is adjudication? You're going for some kind of a dispute resolution. What is this? A dispute resolution you're going for. But settlement means you're not going for dispute resolution. You're just paying the penalty, and then you're telling SEBI that, look, I won't do this again. No appeals are allowed during this time. Okay. Now, for the purpose of recovery of amounts, now let's say that the SEBI is saying, okay, pay up 15 crores because this was the disproportionate gain that you have done. Now, if a person fails to pay the penalty, fails to comply with directions of SEBI or the disgorgement order or any fees due to SEBI, then a recovery officer will be appointed, and he can recover the amounts by either attaching movable property or the bank accounts or immovable property, or even detain a person in prison if necessary. This is how most recovery officers, most recovery officers have these powers. All right. So this is what we call as recovery proceedings. Now, friends, the most important thing is your SAT. Your SAT is nothing other than your Securities Appellate Tribunal. So any order of your SEBI adjudicating officer, you can go to SAT. Within how many days? Within 45 days. Okay, you will get another 45 days if you show sufficient cause. Now, procedure is always the principles of natural justice, that is the right of fair hearing and the rule against bias. Powers of SAT, it has the same powers of the civil court. It can call for documentary and oral evidence. It can issue commissions. It can review its own decisions. It can pass ex parte or dismiss for default. All these powers of civil court are there. Company secretaries can appear before the SAT. Limitation law will also apply before SAT. Whatever goes to SAT, civil courts don't have jurisdiction to hear the matter. From SAT, you can go on appeal to your Supreme Court within 60 days. Now, please understand one thing: you are going to SAT within 45 days. But earlier we saw that if a stock exchange refuses to list securities, you can go on appeal to the SAT, but this time you can go within 15 days. This is the one additional, which is like one exceptional rule, because other times it's 45 days. Only for that it is 15 days time. So don't get confused between this. Your appeal to Supreme Court is always 60 days only. Okay. So now we have, yes, the scores complaint system. Now this is a little bit important because this is a new revamped platform which has come up. The scores platform is nothing other than a complaints redressal platform. So earlier you had an investor would simply file a complaint and then it would have to be redressed, but it was not very efficient. So therefore, what they did was they've revamped this whole what do you say, the scores platform, and what they've done is they've linked it to an online dispute resolution platform. Earlier this wasn't there. Now they've gone ahead and done it. But when I say earlier, I mean before 2023. So like this is nothing other than the full circular that they've given over here. Let's understand what exactly is happening. Now what they're saying is that normally if the investor had to file a complaint, the complaint would only go to the company. Okay, and there were no rules regarding the timelines, there was no oversight, nothing. Okay, but now what they're saying is that there will be oversight. We are going to appoint someone known as designated bodies. Now every time an investor is complaining to, let's say, the company, okay, one person known as a designated body is going to be overseeing this complaint and checking whether it is being done within a proper time. So these designated bodies will monitor and handle the complaints of the investors and non-enforcement actions. Now, what do you mean by enforcement actions? It's usually a penalty or it is some kind of a fine. Like these are all given by SEBI or the stock exchanges. No, these are non enforcement actions, that is, caution letters or referring to SEBI for enforcement. Remember, only SEBI can do enforcement. All others can only take non enforcement actions, which means they can say that, look, you're not doing it properly. You go ahead and do it properly. So it's like you're having some additional people to oversee the whole process. Okay, now let's see what the process is. Let's say I'm the investor. I submit a complaint through the scores platform. This is known as the first complaint. Now this first complaint has to be resolved within 21 days. The minute I lodge my first complaint, what will happen is the complaint will go to the company. It will also go to a designated body. Now, who is this designated body? That's what the scores platform actually creates. Okay. So now what happens is the company has to solve my problem within 21 days. And then the designated body will be overseeing it. Has they have they is the complaint actually over within 21 days or not? Now, if it is over within 21 days, all is well and done. SEBI might do random checks to check whether everything is happening. Now, if everything is resolved, there's no problem. But at the end of 21 days, something known as an ATR is given. What is this? Action taken report. This action taken report, as an investor, I am unhappy with it. Or the ATR is given beyond 21 days. In such a case, what happens is I go for my first review of the complaint. Okay, so please understand, first complaint is to the company itself. But then the designated body is simply overseeing it. But then, by chance, if I'm unhappy and the ATR was given beyond 21 days, I can go for a first review. Okay, to whom? To my designated body itself. To my designated body itself. Now, this can be done. They're saying that, okay, the complainant may request for a review of the resolution provided by the entity within 15 days. So, I've gotten the ATR. I'm unhappy with the ATR. Within 15 days time, I'll have to go on first review. Now, after submitting the ATR, okay, the designated body has to consult with the company and understand what is the problem over here, and then they have to give an ATR within 10 days time. The designated body has to give an action taken report. I'm still unhappy with the action taken report. I can go for a second review. This time it is to SEBI. Now SEBI will call everyone, designated body, company, stakeholders, everyone, and then they will close the matter accordingly. So what can we understand from the scores platform? Scores platform approach the company. Actually, no, I go through the scores platform itself. It's an online platform. So the company will get the complaint, and even the designated body will also get the complaint. Okay, but this is only oversight. I am the investor. Company has to give ATR within 21 days time. Okay, now if this ATR is resolving my issue, then there's no problem. We can close it. But then ATR is not resolved, or I'm unhappy, okay, or ATR ATR is submitted greater than 21 days time, then in that case what do I do? This I can go within 15 days time to for my first review. Now remember, the first review is done by the designated body, but now in consultation with the company. Company will be in the form of a, like, because the company has to give the details, right? How is the designated body supposed to take it up on their own? Now this, I'm still the complainant over here. I have to be given an ATR within how many days? Within 21 days. Oh, sorry, within 10 days time. It's a shorter period. All right. Now, still at this point, let's say it's resolved, then there's no problem. But unresolved, okay, or greater than 10 days time. What can I go for? I can go for my second review. This time, my second review will be with SEBI. SEBI will step in regardless at any point if it feels the need to monitor. But the second review is normally with SEBI itself. Okay, so friends, this is what we call as your second review of the complainant. Now, if the listed companies don't actually finish within the proper timelines, a fine of 1,000 rupees per day can be imposed on the company. All right, and friends, with this we actually come to an end of your chapter. And oh, sorry, there's one last thing. There's the informal guidance scheme. The informal guidance scheme is basically consisting of two things, which is no action letters and your interpretative letters. So no action letters is basically just saying you can take action or no action, whereas interpretative letters is a interpretation of the law, clarification of law. Now what they're saying is that this is merely a the process is you have to file an application with a fee of 50,000 rupees. Within 60 days they will give it. The department will not answer general questions, hypothetical questions. What do you say? No action or interpretative letter has already been issued, or some investigation is ongoing, or before any tribunal or court, or regarding policy concerns. All requests, they don't have confidentiality, which means what? All your If you ask for an action, your interpretative letter or no action letter, it will be published by SEBI in their portal. So if you want confidentiality, you have to request for confidential treatment, and they'll treat you confidentially for 90 days. But after 90 days, what will happen is the SEBI will actually report it in their website. So at that time, they're saying that if you're very sure that you don't want your information published, you have every reason to withdraw the letter within 30 days of communication of rejection. So this is what they're saying. Within 90, only for 90 days, you get secrecy. After 90 days, it will be published in the website. Now, if you don't want it published in the website, you can withdraw your application itself within 30 days time. So this is only what we call as no action letters and interpretative letters. All right. So friends, with this we come to an end of your chapter number 4. That is your chapter number 4. That is SEBI. Okay. Now we'll move on to chapter number 5. That is your depositories and your depositories participants. So here also we'll go a little bit quickly. Depository system, we have the NSDL and we have the CDSL. Okay, it's basically like a bank account for your securities. If you want to, if you want to hold anything through DMAT form or get services of the depository, you have to open an account with your depository participant. All shares will be held in. Just give me a minute. Yeah. Okay. All the share certificates will be held in DMAT form. Okay, and each individual investor is known as the beneficial owner. So, even though I'm the beneficial owner, the depository is considered as the holder of securities. But as the beneficial owner, I will get the right to vote. I will get the right to attend meetings and all the rights that are available to shareholders, not the depository. Depository cannot trade in the securities. So depository, its main activities is for DMAT, even rematerialization, though it is other rules have come in to prevent this rematerialization from taking place. Then electronic settlement of trades in the stock exchange, receipt of transfers, transmissions, etc. Okay, any nomination facilities, all of these facilities will be given by your depository. So then coming down to understanding who is a depository participant, it's nothing other than nothing other than the agent of your depository. Okay, yeah. What is an ISIN number? Whenever a company is going for um, listing its securities in the stock exchange, a 12-digit number is given, which is known as an ISIN number. It's an alphanumeric number which helps me identify that particular stock. So, how exactly is what are the different corporate actions that actually require this? Dividends, bonus, rights issue, etc. Everything is to be done through the depository only. So let's say that a company is going for an IPO. Okay, let's say a company is going for an IPO. It has to the it has to go through a depository, FPO, bonus, rights, dividends, everything will be going through the depository, and then the depository will only further give it to the individual investor. Okay, so that's what they're talking about over here. Investor has to open an account with the depository participant, and then I'll be given something known as a DPID and a client ID. So this DPID and client ID, the client ID is basically given by your depository participant, so that's why I've written 0 over here. Like depending on who you have an account with, whereas your DPID will be useful at the time of voting. Then the depository credits the allottees account with the depository. So in case like I'm getting securities, rights issue, bonus, all of this, it will be given to the depository. Okay, fine. Now we're coming into the Depositories Act itself. Now, Depositories Act is your most important one. Depositories Act basically is the purpose is to establish depositories, dematerialization of securities, making securities fungible in nature, freely transferable, and exempting from stamp duty. So, what happens is that depository, whoever wants to be recognized as a depository, will have to get a certificate of commencement of business from SEBI. So that means the like if you look at a depository, it has to be set up in the form of it needs to get its commencement certificate from SEBI, and it requires to have a net worth of 100 crores. It has to be set up as a company under the Companies Act. So that means incorporate as a company under Companies Act, get a certificate of commencement from SEBI. You have to get your bylaws approved by SEBI. Then you need to have depository participants, because how else will you engage with investors? Make sure you have proper systems in place, and then meet all the other eligibility criteria. So now what they're saying is that you require to have an agreement between the depository and the depository participant. So your let's say Kotak Securities or Zerodha or Grow will enter into an agreement with CDSL for getting all the services of the depository. The individual will have to open an account with the DP and enter into an agreement with the depository. Finally, what is this? It's all a contract. It's all a contract. And then what will happen after that is all your physical securities will have to be given to the depository, will have to be surrendered. Once it's surrendered, they'll convert it into DMAT form, and then only it will be issued to the public. Okay. Options to receive a security certificate or hold securities with the depository. Today they're saying that like section 8 is saying you have the option to hold it either with the depository or in physical form. But today amendments have already come out, and then they're saying that almost everything should be in dematerialized form. Now, any restriction on transfer of securities have to be removed. So they first of all they're saying that SEBI has amended such a way that, let's say I have physical shares with me, I want to transfer it. I can't transfer it unless it's in DMAT form. And now SEBI has also come forward and amended it to the extent that they're saying all the promoter and promoter groups should also have dematerialized their shareholding to 100% before they transfer shares. Now, every depository and the beneficial owner, the depository is always holding in favor of the beneficial owner only. And so, therefore, the depository is required to maintain an index and an index of beneficial owners under the Companies Act. Every time an investor wants to pledge their securities, the depository has to record it, and like the nature of the approval should be filed with the depository. Okay. Now, SEBI has the power. We've studied these powers of SEBI under the previous chapter itself. It can call for information, it can inquire, and it can give directions. It can even ask, it can even make regulations over here. Plus, all of your bylaws of the depository will have to also be approved by SEBI before it is implemented. Okay. Then, friends, penalties can be both civil in nature as well as criminal in nature. So, if you look at the civil activities, it is I'll leave the penalties for you. The adjudication will be done through the settlement and the settlement proceedings. Basically, this we have studied about in the previous chapter. Whereas your offenses are everything of a criminal nature. Okay, so criminal nature, what happens when companies actually perform criminal actions? Every person who was appointed as the manager, director, or the KMP will be liable as guilty, and then they'll be proceeded against, unless of course they show that it was committed without his knowledge, or he had exercised all due diligence to prevent that activity from taking place. Not only KMP, not only officer in default, but even your director, manager, secretary, all of them can also be liable. Since it's an offense, it has to be tried only by what do you say? It will be tried by a special court. Okay, and they're saying that all the civil of the offenses can be compounded. So additionally, they're saying composition under the Code of Criminal Procedure. We don't have the Code of Criminal Procedure. We have the BNS, and we have the BNSS today. Okay, so composition can be done through that. SEBI has the power to grant immunity. A central government has the power to grant immunity in certain cases. And we already know that the depositories have to make bylaws in consultation with SEBI. What are these bylaws relating to? Appoint eligibility criteria for admission, conditions of depository participants, how demat is supposed to take place, the how it ensures safeguards of your investors, how it will, what do you say, distribute dividends, interest, create pledge or hypothecation. Basically, how will it do any activities of the depository? All of these things are on which it can make bylaws on. Now, SEBI has to give approval for these bylaws. Now, if at any point you feel like, okay, what do you say? The depository is required to reconcile all shares on a daily basis. So today I'm selling shares, tomorrow I'm buying shares. It needs to be properly reconciled. And then we have the audit under the depository participants regulations. Now, this is usually done by a company secretary or a chartered accountant or even a cost accountant. This is what we call as what do you say, an audit report on a quarterly basis is given for reconciliation of capital. So what they're saying is that, okay, let's say a company has gone IPO and it has raised 200 crores. Okay, now has this 200 crores been utilized in a proper manner? Okay, has it been given to all the investors? Have shares been given to the investors? Has the company raised money for 1 crore equity shares, but only, let's say, 90 lakh equity shares have been given? If there are some differences like this, it needs to be audited. Okay, so that's why we'll give something known as a reconciliation report on a quarterly basis. It can be signed by a practicing company secretary saying that everything is proper, everything is properly reconciled. Now, as company secretaries, we have the power, okay, to do something known as, yes, we have the ability to do a concurrent audit of depository participants. We can reconcile share capital, internal audit of depository participants, and we can even appear before SAT or before the what do you say, before SEBI also. This is the role of the company secretary. Now you might be wondering, you're like, ma'am, what is this reconciliation of share capital? It's a quarterly return that is to be filed. Similarly, audit, as we already know, it's an auditing of the activities of the depository participants and even doing an internal audit of the same. Now, one thing we need to understand is that all these stockbrokers, VPs, since everything is done in an online mode, okay, we need to ensure that there are proper frameworks to prevent cyber attacks for the same. So that means a cyber audit should be conducted at least once a year by all depository participants. The auditor will have to give a cyber audit report, identify risks and strengths, identify all the risks and strengths, and also maintain up to date systems to ensure safety of the stock exchanges, okay, sorry, of the depositories at least, or even the depository participants. So friends, this is how we come to an end of your chapter number 5, that is DP and depository participants. All right, so I'm going to stop with this class over here. In the next class, we're going to be taking a look at your chapter number 6, that is your market intermediaries and your IFSEA. We'll be doing this. Again, if you want access to any of the further classes or even like the notes and things like that, I've already shown you where you can go. This is the CS Mentor, the website. You can just definitely go over here, go to courses, come down. Okay, it'll either be in the free material tab, or you can choose the courses over here. Okay, open the capital markets section, and then you'll be able to access it over here. Additionally, I've also shown you that classes are available for a monthly basis. So if you feel like you want access to specific chapters, you can just go into the content. I have the notes provided separately, chapter wise is given over here, okay, as well as even the classes, the videos of all these classes are given in a chapter wise basis. Refer to it, study well, and attempt your examination. But let's end for today's class, and we'll start out with chapter number 6 and chapter number 7 in the next class.